Good morning, everyone. Welcome to YX Insights. This is Yimin, and today we're going to do a market update, starting with the Fed liquidity, the yen carry trade, as well as the latest FOMC pricing and the wider bond market. Then we're actually going to do chart analysis on the SPY, QQQ, and then moving on to the mega caps. Netflix printed the results yesterday, so we're going to do a quick review of Netflix and the usual Magnificent Seven stocks, as well as the other mega caps that we've covered so far. All right, so right now is pre-market open, October the 18th. Let's get started. So this is the Fed liquidity chart. So Fed liquidity consists of the Fed balance sheet, Treasury general account, which is the US Treasury's bank account with the Fed, the reverse repo program, which is money markets lending money to the Fed and getting overnight interest rates, and the bank term funding program, which is the rescue fund for the regional bank failure from last year. So the higher the liquidity, theoretically, is the better is more bullish for the market, and also on the bond side, it should be bullish for bonds, which means the yields should come down if there's high liquidity. We had a rising Fed liquidity from the end of last year into the beginning of this year, which corresponded to a sharp rise in SPY. And then there was correction in both the liquidity side as well as the equities market. But since the new year, the Fed liquidity has shrunk quite a bit, and actually now is looking steadily from the peak of 6.5 trillion to now just hovering over 6 trillion. And it dipped as low as 5.8 trillion last month. But in contrast, the stock market has been pretty big so far this year. We had the carry trade blow up in the summer, but that's largely corrected. So we're going to go over that fact as well in the next few slides. We had a big fall in liquidity between August and September due to high levels of TGA and high levels of repo, reverse repo as well. But now it seems to have eased quite a bit from this low, and it's been quite stable. It's been quite flat. It hasn't really gone anywhere in the past week. So that hasn't really helped explain that much about the bond yield or equities market. And if you look at the relationship between the Fed liquidity and bond market, again, usually you observe an inverse relationship between the liquidity and the yield, high liquidity, lower yield, and vice versa. But in the past, I think just 2 weeks, bond yields has been up and up, as we know. Actually, since the Fed cut rates, bond yield, the 10-year bond yield has been on a tear, whereas liquidity initially fell and now rebounded, as I mentioned earlier. But bond yield and liquidity are traveling in the same direction right now. So I do expect that better liquidity, as we're seeing this rebound, should help yield come down a little bit. But that should also support equity market in the near term. And I think it's quite remarkable that equities have been so big given worse Fed liquidity. And I think that really shows how bullish we are as a market. Just want to bring back this carry trade chart. So this line here is the QQQ versus the blue line, which is the 10-year bond spread between the US and Japan. So the higher this spread, it means the US Treasury yield, 10-year yield, is higher, is increasing versus Japanese 10-year yield bond yield. And the main driver of this spread is really the US leg, because the US bond yield is much higher. It's at 4% versus 1% in Japan. And that fluctuates a lot more than the Japanese bond yield. So what we have seen is a remarkable correlation or relationship between them two since the summer. So we had the carry trade unwind here, where the bond spread narrowed, and there was a risk-off period between July and August. Then the market, there was a decoupling over here in the late August, and then again we're moving the same direction since September. So as this spread narrowed, which means the cost of funding the carry trade is rising versus the return is return falling on which is the US spread, US yield. So as this spread narrows, the cost of carry trade rises versus the return it's getting. So it's bad for risk assets. And as the spread rises again, driven by the 10-year bond yield, actually the equities market have become much more risk on. So that's we're seeing this relationship right now. So it feels like the Fed liquidity chart is on the back seat, is kind of like secondary right now versus this spread. So when you just keep I don't think there's one overarching explanation for everything, but we'll just keep an eye on all those different moving legs to make sure we're on top of the game. So this is the FOMC pricing for this year, for the next year actually. What we see is that since the 50 basis point jumbo cuts in September, we actually saw the bond market pricing out a lot of previously aggressively cuts that were priced in before the meeting. So now, well, we're seeing that we're still expecting 3 consecutive 25 basis point cuts. And the reason this is done this way is that I think the market is slightly pricing in less of a chance for a December cut, and that's compensated for by the pricing in March. But together, it really suggests 3 consecutive cuts, and then we likely skip one in March, and we'll have new cuts in in May and June. So, what's really noticeable is that this 3.34 terminal rate that the market is pricing in by end of next year is very high compared to what we had pre-September FOMC. Before the September FOMC, we had this terminal rate at 2.75. So why is that? There are a few explanations for this. First, the non-farm payrolls have come in much better than expected, and the unemployment rate actually fell. Right, so I think that is a big piece of the puzzle that the Fed is trying to solve through the monetary policy. They don't want the labor market to further soften, and they're willing to cut aggressively if that is the case. But because the data have been benign, there's less pressure for the Fed to cut. But also the CPI has come in slightly worse than expected, so a tick higher for both the headline and core. That's really driven by the wage growth from the month before. And we predicted this going into the CPI. But I think broad scheme of things, probably not a big concern for the Fed yet, because things like shelter are actually improving quite a lot. And also car sales and car insurance cost is also not rising as sharply as before. So these are the big factors in the CPI calculation, and they have been okay, whereas the rest of the other components did come up higher than before, but they are probably much more temporary. So this is just the yield curve in the SOFR 3-month, just to visualize what it's like going out into 2029 in the next 5 years. So you can see that it's a quite steep drop still, and the terminal rate 3.33. The market thinks the neutral rate, essentially the rate that holds the economy neither expansionary or recessionary, is at this level, and it's higher than before. And then we're going to stay at this level in up until 2029. I think the market really is having this renewed belief of higher rates because of higher inflation expectation from the recent oil prices surge. And I think it might sound a bit silly that, okay, so you have the Middle East conflict, and that's driven some oil prices resurgence. But then how is that translating into longer term inflation? But actually, if you look at where the market is pricing in terms of inflation expectation versus the oil prices, so the USO is the green line, and the inflation expectation 5-year break even. Inflation expectation is the blue line. They're pretty much correlated, right? So when oil goes up, inflation expectations go up. Oil goes down, inflation expectations go down, etc. So this is historically been very strong in terms of correlation. And the market takes the oil prices as an input and inflation expectation as an output. So unless oil prices actually fall further, the inflation expectation will remain elevated, even though it's a 5-year. So this inflation expectation is a 5-year measure, not just 1 year. And then just going back to here, this curve, that's why this curve is remaining very elevated for the entire 5-year duration, rather than expecting further cuts after year 2, 3, 4. So that's how the market kind of works. I do think that this level is quite high, because I think the chance of a recession isn't over, given the economic indicators we're seeing in terms of the Simon rule, as well as the yield curve reversion. So, and these are quite robust indicators, historically speaking. So I do think if we do get the recessionary indicators back on, the market refocusing on those risks, we'll see this terminal yield much, much lower. But that's how the market is working right now, the pricing right now, and we just take it as it is. And what I do think is that if we want to fade this move, as in if we see yields lower and bonds prices higher, oil prices, a USO is actually quite a good hedge. So that's my rationale for having USO in your portfolio as a hedge against everything else. So now I'm finished with the presentation. I'm going to move on to TradingView, and we're going to go through the market charts. All right, so let's start with SPY. I think the market is extremely bullish right now, and obviously there are always going to be bears talking about imminent market crash. But I think the sentiment right now is there is FOMO, or at least fear of underperforming the benchmark. And as we enter a new high, I think there's a lot more room in this swing going into. We might get a little bit of volatility going into the election, but I think there's a lot more room higher, at least going into the new year. We can get a sharper correction, possibly after we reach 640, or at least between 620 and 640. We can get a bigger correction there. But I think there is still like one more leg of blow off top towards 680 region. And of course, once we get to finish this wave 3, see wave 3, my expectation is that the pullback can be quite steep, all the way to 530. Technically, that should be a bear market once we complete the wave 4. So we can get a bear market from a technical perspective after we reach 680. And I think a lot of people will be like, oh yeah, look at me, I'm right all along, etc. But then they are probably like 100 points too late. They're missing out this upside move from now. I don't really have a lot to add from here going into the year, going into this 680 target. We have, I think the market seems quite anxious because VIX is quite high relative to where we are at in terms of all-time highs. But the pullbacks have been pretty shallow so far, and it just really suggests that the market is chasing and climbing the wall of worry higher. For QQQ, again, I expect us to make a higher move, and possibly with a bigger upside than SPY. We had a slightly deeper pullback in September. And that would suggest to me that this wave 4 correction might be actually quite shallow. So we could have much shallow wave 4 and then just get to 600 much more quickly than people expect. I think QQQ hasn't made all-time high yet, hasn't made a new all-time high yet, slightly behind SPY. And I think there could be money rotating into QQQ for the catch-up trade from here. But I don't really have that much more to add than this chart. So now I just want to get to Netflix, because I just wrote an article on this before the report. So Netflix has been doing pretty well. It's seen accelerating growth in the past 6 quarters. It had a really miserable time when Bill Ackman sold, right? So I don't know if you remember, Bill Ackman famously bought the dip 2 years ago and then sold a quarter later because he doesn't believe in the thesis around ad-supported growth. And he's, at a fundamental level, he's probably right, because the ad-supported growth hasn't really come through yet as a revenue driver. But the fundamentals, everything else looks pretty great since he left the scene. And actually, it's recovered from 162 to 700. Pretty remarkable, with the help of share buybacks as well. So the share buybacks, still half the tank is still full. There's still dry powder left in the repurchase program. So I do think we can get higher. The only thing I'm concerned, and this is before the market open after the latest report, which I'll talk about in a second, is that we have this move here, with 1 and 2, 3. So I think, so we reached 1.382 retrace, extension of wave 1, and that is actually quite a standard target for wave 3 high, right? And you can, obviously this move can extend another level up to 1.618 extension, which is 800 level. But technically speaking, there's sufficient length already for wave 3 to be deemed complete. So that's why I was cautious going into this meeting. Going into this earnings report. So in terms of the shorter term, if you look at the VWAP, the volume traded average price, from January 2024, it's been pretty good. This VWAP's been tested twice, and both time it stood, and it's been just going up straight from here. And I think this overall trend is pretty strong. I wouldn't try to fade it. So I do think, like, if we have a correction here, because wave 3 has sufficient length, it will be likely quite shallow, and and I think that the longer term move is higher, and we could possibly get a blow off top from here. So if we, let's say, even if we reach 800 and retrace here, my target for the entire cycle is really 1,000 here, and that's nearly 50% higher from where we are today. And just to look at the report from yesterday, I've done some homework on this. So revenue growth 15% year on year, brilliant. Is on the higher side of the range. I think they guided between 14 to 15%. Operating margin 30%, again up from 22% in Q3. So it's pretty big improvement in 1 year's time. And the operating income, 2.9 billion, up 52% year on year. Net income, 2.3 billion, up 45% year on year. So the earning, the profitability, the profits are growing pretty rapidly for Netflix, which means a higher valuation metric is justified. So the paid membership growth is slower. So only 5 million new net additions in Q3 versus 8.76 million. So it seems to be much harder. I think a couple of years ago, they started really cracking down on this definition of household and on the password sharing. So now as a user, if you want to share your password with your cousin or something, you actually have to purchase a new slot and gift it to them. And they really try to track your IP, where you're logging in, etc., and whether the TVs that are operating are in the same household, which is quite annoying for the users, but it's great for profitability. And to be honest, like if you're a Netflix user, I think most of us are quite addicted to the Netflix streaming. It's really hard to cancel. And especially now they have loads more original content, um, both TV programs and films. So I do think they have a quite strong moat there. They are the second biggest streaming company behind YouTube, capturing around 80% of the TV screen time in the US. But it's very different to YouTube because YouTube is really content creator driven. And so the content creators put in all sorts of things up there, documentaries, shorts, long form, short format. But Netflix is more of a top-down approach. They really create the content you see, and they create their own shows, etc. And it's a very different format as well as a kind of use case versus YouTube. And they are 5 percentage points ahead of Prime and 6 percentage points ahead of Hulu and Disney. So I would not fade this company just because the share price has gone up so much in the past 2 years. Ad-supported memberships have grown quite a bit from a low base, but I think the tricky part is how to get as much revenue from the ad-supported users versus the full paying users. The full-year forecast is 15% growth and an operating margin of 27%. So I think these are pretty strong numbers. Trading 12-month revenue now climbing to 15%, pretty much growing year on year. So this is not the quarterly revenue, it's the trading 12 month of the previous 4 quarters, essentially. Rising nicely for the past year, 6 quarters. And then we have the profit margins. You can see that the gross margin increased in this quarter, and as well as operating margin now reaching 30%, which is higher than 27% from the last quarter and miles higher than last year. So pretty strong growth. I'm just really waiting for a nice dip before getting in. So nothing to do for now. Apple. I think I've eliminated the bag case where this could be an ABC retrace, and it's quite a shallow B wave here. So I see this because it's a wave 5. I think we are having a 3-3-3 structure in the 5 waves, which means wave 1 has ABC, wave 2, and then ABC down for wave 2, and then ABC for wave 3. And typically the C wave is composed of 5 legs, and they tend to be higher, slightly longer than the A wave. So I think now we're actually moving towards wave 3. And we could, this is quite a shallow pullback for wave 2. So we could get a steeper pullback in wave 4, but ultimately I think this larger degree wave 3 will finish in the 315 to 320 region. So I think if you were to trade this, what I would personally, I think this is not a bad risk reward if we target 310 region-ish and put a stop. So this is not good risk reward having this B low, but you can put it somewhere like there's a VWAP here, supported VWAP here, and which is actually also where the most heavy volume profile is. So if it dips below the VWAP as well as this volume region, then I think the chances are it will go much further down. So I think having here is quite good risk reward as well for a medium term trade. Amazon has been quite difficult to decipher for this wave, and again, this is a larger degree wave 1, right? So I think we had a big correction going into 2022, and we're now approaching the all-time high. We just broke through it in July, and it has really stalled. It does look like a bit like a cup and handle formation in the classic case, and I do think we should move higher sooner or later. The only question is in what shape or form it's going to move. And it took me a while to really see this chart. And I think we are in a diagonal move again for this wave one. So diagonals typically happen. So leading diagonals typically happen in wave one, and the ending diagonals in wave five. And diagonals, what they are is instead of the usual 5-3-5-3-5 structure of impulse versus corrective waves, we see 3-3-3-3-3 in all of the waves. And wave four can overlap with wave one. So this is not my primary expectation, but that could happen. What I really see is that this is actually a wave ABC up. And we see this in a lot of this pattern in a lot of the mega caps actually. ABC up for wave one, and now we're in wave three, and we had ABC correction. And in terms of shorter term, the price technicals is quite bullish. First, it's way above the VWAP since the August crash, as well as sitting on the volume profile over here, the most heavily traded region here. So the overall Amazon shareholders are most likely in profit. If you bought here, of course, you're underwater, which some people did. You can see through the volume here. But the great majority of Amazon shareholders are in profit, and they shouldn't be too eager to sell so far. So my expectation is we'll get to 230 to 250 level eventually in this broader move for wave C of three. We can see a steeper pullback over here once we get to 230 level. But I do think the next wave is up. I just want to present an alternative scenario I've seen elsewhere. And I think some people would argue that this is wave one, wave two, wave three, wave four, and wave five, and we're in the correction territory, and this is A and B and C. And I think it could happen, but on the wider scale. So you could, I mean, these could be a feasible count, but in terms of proportionality, in terms of wave three versus wave five, and on the wider scale of where Amazon should be, in terms of overall progress of this wave one, two, and this broader, larger degree wave circle five, I don't think we are topped already. So I do think we have more legs to go. And in terms of valuation wise, Amazon is also relatively cheaply valued given its growth rate compared to other Magnificent Seven peers. So I'm bullish. But I want you to be aware of the other bearish alternatives, just in case that does play out. Again, a lot of the technical analysis, as much as we try, it is subjective, and we're using theories and tools to measure all the impulse waves, etc. But at the end of the day, it's a subjective assessment of what's the higher probability path. And it should never take it as for granted that this will definitely happen, because a market moves very fast, and I'm also human. I could be wrong as well. So just take everything with a pinch of salt and do your own sort of analysis as well, and see if you arrive at the same conclusions. So for Google, I see we are in. I have also redone this chart slightly, but overall, I do expect the medium term to be up above 200. So where we are now is at a junction where the market is undecided on the next big move. And what I think is that we had wave three, wave four here, and that stopped. We're now rising into wave one and with a wave two retrace. And this sharp rise here is a B wave. And so these two black lines are VWAPs. This is the VWAP from the July high. it shows that if you, since July, what's the average price of people buying in terms of volume weighted? And it shows that we're pretty much sitting on this VWAP now. So the average price people have bought, volume weighted wise, is basically around the current level. And also since September, the VWAP is the black line here. People have also got a similar price level as they entered. So we're right at this level where we're basically at the average trading volume weighted trading price of the market participants. And you can also see that in terms of volume, this is the most heavily traded region. So the market has to decide whether the next leg is up, is trying to break up or down, because they're really neutral at this moment. My read is that we should get a retrace here, and then try to move up again, and that will propel us much higher into the 200 region. But I mean, if we get really shallow, if let's say it's wave 1 and 2, which is pretty shallow. So it's a 38% retrace. What this means is that wave 3 is probably going to be much higher, and wave 4 will see a bigger correction. So wave 3 from here, I would think could move to 200 directly, and then a bigger correction here for wave 4. And proportionally wise, if wave 2 is shallow, wave 4 tends to be steep. And if wave 2 is steep, if wave 2 is steep, wave 4 tends to be shallow. And it's really about market psychology. If we had a really big bullish run up with the shallow wave 2, where everyone's partying really fast, then wave 4 is where people are thinking maybe we've topped already, let's take the chips off the table, but actually that is a bear trap. Whereas if we already digested this early move in the steeper wave 2, then wave 4 will see a lot less resistance. And I think we'll just move sideways for a little bit and for final wave to let more people get on the bus, as it were. Meta, I'm hoping for a correction here so we can take advantage. I think overall we're again in the heart of wave 3 of this wave 5. It's an incredibly profitable company, as I've shown you my fundamental analysis, and I think Zuckerberg has really turned this around since the share price fell to sub $100 2 years ago. I think so. Technically speaking, the stock is very bullish, way above the VWAP from the August crash, and also above the volume traded areas, and it's above its all-time high. So I don't think momentum will slow that much. How deep this wave 4 gets is hard to say right now, because we had a quite steep wave 2 retrace, which means wave 4 might be quite shallow, as I mentioned earlier. But let's say if what I'm really hoping for is that now it's reached the 1.618 extension. If we can get a retrace to this one extension here, and then possibly we have a trade, and that would be sitting right on top of this VWAP as well as the volume profile. We can have a nice final leg of 20% run up for this wave 5, and we can have a quite small stop loss, 5-6%, just below this VWAP stop and the volume profile here. So I think that's my hope, but obviously the market might not give us this opportunity. But if it does, I'm happy to pull the trigger. MSFT, Microsoft. So the problem I have with Microsoft is that we had a quite steep wave, steep fall here. It is enough to say, okay, this is enough to say this pullback is complete for wave 4. And if you look at this entire wave 3, It's fallen by over 23.6%. So wave four, for wave four, that is sufficient. But just looking at the overall structure, we had a sharp move down, and I think this is a 5-wave move, and then a 3-wave move up. It really does feel like a B wave here. And we can get a move lower to this move C region, wave C region of 363. And certainly if we break below 400, we should get that. You could argue this is wave 1 and 2. And you could argue because we're in the wave 5, we'll have 3 wave moves, like I mentioned, a ending diagonal with ABC here, and then ABC going into the wave 5 as well. So that is that could be the case. I do think that if we put that trade on entering now, we should be having a good, very tight stop. So if you want to put this one, if I want to put this one on here, 30% rise towards this end, wave 5 end, I'm happy to have a stop at least over here, 385 region, because that would invalidate my thesis, and this should be a wave 3 and wave C down, and the wave C is longer than the wave A, so I would just really want to stay out of the way here. So primarily, I think in terms of overall market, I was going to say my primary expectation is the black count, but actually, given the broader market, I think it's probably 50-50 right now. Microsoft is pretty expensive valuation-wise, which is why I put underweight on Microsoft, and I think the technicals would line up with a bigger correction to bring the valuation down a bit. But because overall market is pretty bullish, as we see in SPY and QQQ, it's quite hard for Microsoft to go much lower with the rest of the market going higher. It could happen. Tesla has been the case. So on the balance, I'm indifferent between the two paths. If you want to try have the trade here already, instead of waiting for a confirmation signal, I would really have a stop. I personally would have a stop over here, and it's still pretty good risk reward. NVIDIA, and I think NVIDIA is very similar in terms of what I just said. We're all moving towards this, wave 5 end state, right? So what we see is that the first leg down is a 5-wave move, very clear 5-wave move, and the waves up is a really clear 3-wave move so far, and that still could be a B wave, and the B wave can be higher than where it started in a bullish market. Is expanded flat, so it's really hard. I mean, I think I've put this as an alternative now, and I think overall we should see higher, given where the market is going, the broader market is going. Again, I feel like there's not much of an opportunity in NVIDIA. If we place a stop here, that's a pretty wide stop, and I just don't see enough upside. 50% upside is great if we can get it, but it's not in terms of risk reward basis. So for me, I'm leaning bullish. The market technicals is pretty bullish, is way above the VWAP as well as the most heavily traded area here. So there's nothing that would suggest it couldn't go higher from both valuation perspective and technical perspective. It's just that this 5-wave down and 3-wave up still puts this B wave as a possible alternative. So I'm just mindful of this possibility, but also not enough risk reward for me to get in on NVIDIA here. And then Tesla. Tesla, we have a trade on. Um, and I want to show you both the bullish and the bearish alternative on the grand scheme of things. So Tesla is a company that heavily relies on the Elon Musk narrative, right? So 90% of its revenue comes from car production. So it is a car company and is very expensively valued as a car company. I would say is the car company component is probably in terms of the valuation is a small percentage of what the valuation what the market is valuing. The market's really saying that Tesla is a robot taxi company and also the robot humanoid company, but robot taxi company primarily. So robot taxis are much higher in margin. It can become almost like investment assets. If you think about it's a depreciating asset, but you can get investment returns on your renting out the car as a taxi, right? So we can value it that way in terms of robo taxi, and Tesla probably will want to claim certain profit share with from the owners using its software, right? So they sell the owners the car, and they will charge some sort of profit or SaaS type of model for its self-driving software for the users. The thing is, we're still really early on in this game. We still have regulatory challenges for this, which is why the robotaxis were the event was hosted in Hollywood rather than the open road. So we're still in the early innings, and I don't blame investors who don't want to go long on Tesla here. They want to see more proof, and that's very prudent in terms of taking. If you are in charge of huge client portfolios, you have a fiduciary duty to protect their capital. And if you think this is still very early in the game for Tesla, and Tesla ultimately is a car company, and then you probably wouldn't want to buy in. And I don't think there's anything wrong with that bearish view at all. And how likely will this robotaxi, how big the market is, how likely will play out, and how much dominance that Tesla will have is all pretty uncertain at this moment. So really, we're betting a 25% chance of a $1 trillion market being owned by Tesla right now, right? So it is a gamble. What this means is that Tesla is a poor company for fundamental analysis at this point. The fundamental analysis is really quite irrelevant for its share price. What's relevant is really the market sentiment, investor sentiment towards the stock, towards the future that Elon is trying to show, and that makes it better for technical analysis. So you can really just analyze Tesla based on the technicals rather than the fundamentals. So now entering the technical side, I think we put in a 1 and 2 here, and we've had, and on the larger degree chart here, again, we're in the wave circle 5. And like the other companies we've seen so far, we could get a diagonal in this wave circle 5, and that gives us the 333 structures for all of the 5 waves. And right now, it seems like we are in wave 3 and wave A of wave 3. And just zooming in, from the May low or the April low, Tesla has tested this VWAP several times and stood, and we're now resting above it, which makes a quite good spot for entering the trade. And is also standing right above this most heavily traded volume. So below that, if the share price falls below this black line and this volume here, it could travel quite fast down to 180. And I just want to show you how I've constructed this trade. So I'm really aiming for the end point of this wave A, which is so we've finished A, B, and now looking at C, and C is 5-wave move typically, and I want to have a stop loss below this B low, right? So entering here, that gives us a 3.8 3.8 risk reward ratio. I would refrain from having a shallower stop loss. I can understand why one would want to have a shallow stop loss. I mean, if it breaches this VWAP and also this vacuum here, fall quite fast, but it's pretty volatile stock. And we can get blown out of our position quite quickly if we have too shallow a stop. So I would have it around here or even below this level, 170. And it still makes a pretty good risk reward. And if falling below here is pretty bearish. So longer term, I do think we should get to first just under 400 in the rest of this A wave, and then to finish wave 3 off, where you get to high 600s, 100, or just below 700. And I think this entire cycle would finish with Tesla around 1,000 mark. It's hard to assess exact levels until wave 3 has played out, but that's my primary expectation. However, I do want to show you this. This is an alternative count for Tesla from the pre-COVID rally. So if you say the pre-COVID rally is 1, 2, and this is wave 3 and 4 and 5, as opposed to being wave 3 ending here, then this cycle would have ended here already, and we're really in the bigger A, B, C correction. And this is a B. This 1, 2, 3 is a B wave, and actually this rally here is a bearish 1, 2 rally, 1, 2 setup to the downside, and C could end at 40, between 40 and 50. The reason I want to show this chart is not that I think this is a primary case, but we just have to be aware that there is a possibility for this to play out. And this is basically saying the market is completely abandoning the robo-taxi story until Elon Musk proves himself. And that would see a steep drop of share price of 75%, which is why we should always have a stop loss for every trade, right? If we are wrong in our primary assessment here, we are being protected to the downside. And I think when I first started trading, I love to double down. I think, oh, things are getting cheaper and cheaper. Warren Buffett says, be greedy when others are fearful. But actually, now understanding a lot more about the technical aspect of the price, I will just stand out of the way, stay out of the way here, let the chart play out, not pick the bottom, and probably only start cautiously building when it gets to this region, in the 50s region here. So that's my thesis and antithesis on Tesla. Take it as you will. And finally, CRM is a pretty bullish chart. So it's a pretty bullish chart in the sense that first, this is a copper handle again. So I do expect CRM to extend further into the 700 area. Fundamentally, they are so they are basically betting on this thing called agent force, and where agent force is AI. It's like a co-pilot. It's not really a co-pilot. So it's an AI that's much smarter than previous chatbots, and it helps you do sales outreach, interact with customers, do customer support, or for employees to answer questions about HR or company information. You can put all your company information in there, etc. Obviously, the downside is that, the good side is high profitability. I think Salesforce has refused on an interview to say what models they're using. But there's also saying that customers don't really care about what models they're using. As long as the customers can take it off the shelf and rapidly deploy it in their own company, they're happy, and they would happily pay Salesforce something like $2 per conversation, for example. And that's much cheaper than employing a salesperson, for example, to do sales outreach. The downside, obviously, for broader society point of view, is that once you have the AI coming in to take over all the, consume all the company information, internal information, and churn out all this stuff, there's going to be a loss of knowledge among the workforce in the neo generation of the workforce, which may be good, may be bad, who knows? But that is a downside for, I think, for in terms of a talent perspective for the company, I guess. Without getting into the whole, business building side of things, what I think is that this is a very shallow wave 1, 2, 1, 2, 3, 4, 5, a steeper wave 4 pullback, and a quite extended fifth wave. It does look like a ABC being being constructed here. But if I'm wrong, I would have a stop loss here. So if I want to enter, so this is still a pretty high target. So I would probably have a stop loss if I were to enter the trade today without looking at pullbacks or anything. I would probably have my stop over here. Is pretty wide, 30%. First is below this VWAP from the 2023 low. So you immediately know that the average market participant is underwater, and they're probably looking to sell at the bounce. And second is below this heavily traded volume, which acts as support. So if breaking this level of 200, we get a much more bearish view, which is a steeper wave 2 pullback. The reason I expect a wave C here is because this is really a 3-wave rally into wave B, and it's pretty shallow wave 2 retrace as well. So my primary expectation is still hopefully we get a steeper wave 2, and then we can use this as a stop and a much, much higher 300% return. But if we don't get it, and if we want to enter aggressively now, having the right stop loss and position sizing is also viable, essentially. ADBE. So I'll cover this week as well. So what I think is that we are in the wave C correction of this wave 1. And this is expanded flat, which it just means the wave B is higher than this wave 1 high, and wave C is lower than the wave A low. And I think the wave C should be, if we just look at where this wave A is. So from the equal measure perspective, wave A, so this leg is already much higher, longer than this wave A. So you could say it's sort of sufficient, and you can start building a position. But I'm just looking at proportionally within this wave C. We could have a wave, so like ABC lower here, and into the 446 region. And just looking at this final leg on the micro level, also it points to this downside here. So I don't mind waiting, and this really enters again. This V is getting supported by this VWAP here, and this VWAP from the September September high has acted as resistance. It's failing to break it. So in the short term, I actually much rather waiting for this to break up. So if it already bounces, so let's say we've already had a low here and it breaks higher here, I would want to wait for this chart to essentially get above this green line here, which is 3% above this VWAP. So it's a decisive breakout. It's also above this volume profile here. And that's still a pretty good 3-to-1 reward. So if the chart start moving up and have put this as a low already, I'll wait for the breakout. But if the chart start moving down towards this target, I'll probably not wait for the breakout because I think the risk reward is pretty good already. I don't need a confirmational signal as much, but I would still have this trade protected having a low here, this wave for low, just in case that, instead of this being a wave for low, is actually a B, C pointing much lower. So that's just my thought here. So I think Adobe is a steady company, mature company, growing at 10% a year. Pretty good margins, extremely high margins, and it has a strong business model, right? Like in terms of design, Photoshop, video editing, and PDFs, etc. So in the long term, I wouldn't bet against this company at all. It's just a matter of having the risk reward. It's come off still significantly below all-time high, and this does look like a cup and handle as well from a classical analysis point of view. So I do think everything does point to the upside. It's just about really picking your spot on where to enter. So for me, I'm happy to wait for the chart to become a bit more obvious to me, whether we're gonna build a low here, or if you build a low already, we're gonna chase the breakout. So I think that's it for the mega cap session. I'll post all the charts, all the slides into the newsletter as well. And happy weekend. Thank you.